you and I both know that the real estate industry cannot continue at the heated pace and rate that it is right now. There are going to be changes. There's going to be a shift. The question becomes, how are you going to prepare for it? Are you going to be positioned with the network, with the knowledge, with the mindset to be able to benefit from it as opposed to be jeopardized by it? This episode with Paul Birkett is going to help you do that, help you understand what's coming and how to position yourself to benefit from what's on the horizon. Enjoy. Welcome back to the Think Bigger Real Estate Show. I'm your host, Justin Stoddart. I'm excited today to bring with you another big thinker, somebody who's built an amazing company called Automation Finance that has some predictions for the future of the housing industry that you need to hear about, more to position yourself to be able to take advantage of the opportunities. Before I introduce today's guest, I want to remind you that we take snippets of every episode and we put them inside of the Think Bigger Real Estate group on Facebook. If you're not yet a member of that group, if you're not yet engaging in that group, there's so much value that's easy for you to digest, consume, and apply in your business, helping you also to become a big thinker and a high achiever. Back to today's guest, his name's Paul Birkett. He had years and years of corporate experience and realized that it was time for him to become an entrepreneur. Again, built a company that is doing some amazing things when it comes to helping with, I think, what we could all say is at some point there's going to be a housing industry correction. We've been on fire for years. And historically, that just doesn't happen. With at some point, there'd be at least a flattening out, most likely a correction. How do we position ourselves to where we are not victim to that, but we're positioned to really seize the opportunity that's there? Paul Birkett, thank you so much for coming on the show today.
Great to be on, Justin. Thanks for having me.
Yes. Tell us your story. You haven't always been an entrepreneur, haven't always been kind of the founder of Automation Finance. Tell us kind of your background and maybe how that contributed to the position that you're in today and the value that you can bring to residential real estate agents.
Well, I guess I was an entrepreneur as a kid. I was the guy who delivered the newspapers and washed cars and mowed lawns, but then went off and did a 20-year career in corporate America, lived all around the world running different parts of businesses for 2 Fortune 50 companies. And came to the US in 2010. So I'd owned some residential real estate in the past, just buy and hold rentals, and got to Florida in 2010. And those of your listeners who were in the real estate game in 2010 will remember that was really the low point on the whole price appreciation scale. So I started buying $80,000 houses, which are probably worth $300,000 today, and renovated them a little bit, rented them out, and raised a little external money to do that. And then a short sale became a note sale. This blew my mind because in Europe, only a bank can own a mortgage. You can't even advance credit to someone unless you're a licensed entity. And so it took me a while to understand that with minimal licensing, you can own a mortgage. And so I bought one mortgage and figured out how to do it. And that was 6 years ago. And we have about 2,500 of them today. And our twist is we buy them when the borrower is not paying, or they're paying sometimes. And we restructure the loans to get them paying all of the time. And the reason I'm on is because that whole process that we saw in 2008 is just starting again right now.
Let's talk a little bit about that. I think it's a fascinating model, right? Rather than taking over the homes and displacing families, you're doing the opposite. You're actually helping extend kind of a line of help to these families that are in need and not paying for whatever reason. Right? Obviously, the pandemic has put a certain crunch upon not just families being able to pay mortgages, but also landlords. Right? Talk to us a little bit about these individuals who aren't these big institution landlords. Right? They're kind of ma and pa. And somebody not paying the mortgage for a series of either a month or several months creates quite the pain upon them and quite the financial pandemic, if you will, upon those people. Kind of talk to us about what you're seeing, Paul.
Right. Well, the market splits about 80-20. The 80% of people at the top, they're doing just fine. They've got conventional financing, their mortgages owned by Fannie or Freddie. They're maybe in forbearance. They've just finished the first 6 months and they'll get another 6 months. So they're going to be okay until March or April or May of next year. And it's unlikely we'll see too much distress there. The other 20% are the people who are entrepreneurs, restaurant owners, people in hospitality, in all of the industries that have been so badly hit by this virus. And they were not able to qualify for conventional financing, so their mortgages are held in some sort of a private label security. And the owners of those securities are not providing programmatic forbearance programs. So some people are getting them, but some are not. And a lot of those will enter foreclosure in the months and maybe 6 months ahead, because as your listeners know, the real estate market doesn't turn on a dime. It takes 6 or 8 months. If you remember the 2008 crash, we didn't hit the bottom until I think it was May or June of 2011. So it takes a while. And I think there's two themes. The first one is about 40% of landlords only own a single property. And so, as we know, we read in every newspaper and hear on every news show every day, 50% rent collection, 40% rent collection, something less than, say, 60%. So if people are not paying the rent, then the one-off mom and pop landlord is not paying their mortgage. And that mortgage is probably owned by a non-federally backed entity, and that's going to head into foreclosure and will probably end up on my desk in the next 6 or 9 months.
What are there certain areas that you're seeing affected more than others? Like, for example, as a residential real estate agent listening to this episode, how would you advise them to best position themselves? Right, I'm based out of Portland, Oregon. My audience is around the country, so we got people listening from all over the place. But where is it that you're finding that people are going to be most affected? And again, how can an agent position themselves to not fall victim, but to take advantage of the opportunity?
Sure. I think Portland is a great example of the outlying districts outside of city centre is going to do fantastically well. It's a wonderful place to live. The places we're seeing real distress is places like Manhattan. Last week, I saw a $10 million apartment with a $6 million mortgage that was a year in arrears, and that's selling at 50 cents on the dollar. And that is a Park Avenue kind of address. There's nothing more premium than that. You're seeing the same things in downtown Chicago, downtown San Francisco, LA, all of the big cities with high density and a lot of, like the amenities that attract you to Manhattan are fantastic restaurants, lots of theater, lots of stuff to do. Well, if you take away all of those things, then why would you want to live in a really expensive city like Manhattan, which is where I live? But you're seeing a lot of price increases out in the Hamptons. So places where the commuters go, like on weekends and upmarket people live, big price increases there. The upside will be all the places people commute to. So we're seeing places like the Carolinas are really doing very well. A lot of outward migration from the eastern seaboard, big cities to there. And what we'll also see is now that we're seeing month after month of record low, all-time low mortgage rates, anyone with a decent credit score will buy a home. And those will be at the bottom end, typically the bottom end. So I think you'll see a lot of what I call forced appreciation on lower priced homes. And by that, I mean 100 grand up to maybe 250 grand. I think we'll see a lot of appreciation there for two reasons. One, it's very hard for new builds to compete in that space. You can't build homes to meet all of the legal guidelines at that price point. And secondly, there's a very limited supply of existing stock. So that just will put pressure on prices upwards.
Interesting. I think that's probably some of the best advice I've heard. And I've interviewed economists, and that's really, I think, sound, right? Both what you're seeing, both with the crisis of people getting out of big cities, as well as what that's going to cost, right? Is a massive shortage in those areas, price escalation. And again, I think if you look at certain recessions, my episode, the purpose behind why I do what I do is I believe that there is the greatest natural resource that's untapped in the world is human potential. And I see people in every market, even in great markets, I see people struggle. And of course, I see a large number of people do well. In down markets, I see a lot of people struggle, and I see some people really thrive. And so it really comes down to your mindset and how you are going to be preparing yourself, your mindset, your skill set, your networks, your knowledge to be able to capitalize when things shift and when things change. And so this is all, very, very insightful.
Right. We've seen this cycle before in 2008. The brokers that succeed should now be studying how to do short sales if you haven't done those before. If you're 3 or 4 years in the game, maybe short sales is a new concept for you. How are you going to manage REO? How are you going to be a service to the mortgage industry who will be looking to buy and dispose of these properties? And it's just like night follows day. You're going to hear that more and more often in the next 12 months.
I want to pivot, Paul. You've obviously transitioned out of corporate life into entrepreneur life. And I think most of the people that are watching this show are in positions where they're entrepreneurs, small business owners. What advice would you have for the small business crowd listening, right? For those that are saying, I want to be positioned not just with the market, but I also want to be a sound business owner. There's some, a lesson or two that you can share with us that has helped you really become an astute and sound business owner.
I think the first thing is, like, always start with the end in mind. What exact business do you want to own, and why do you want to own it? And be honest with yourself about what your skill sets are and what the gaps are, and what steps can you take to fill those gaps. For example, I knew nothing about the real estate market other than being an amateur landlord. I owned 30 homes that I built up in a relatively short period of time. I made every mistake there was to make, but I wanted to find a business that I could scale. Once I'd proven that I could do it with 30, I was able to raise external financing from Wall Street. And I raised that, and I paid way too much for it, but I learned a lot of lessons by doing it. And after 5 years as a landlord, I made some money, but the real money was made by Wall Street. So my next round of financing, we did a SEC registered crowd fund. And so that meant I could raise money from ordinary people like me to buy these mortgages, which we now do. So rather than paying an 8% return to the Wall Street investor, I pay it just to ordinary people. So everyone can get involved in that. The more you dig into your business, the more opportunities you will find. The hardest thing is diving off the diving board, because there's no way to gently get off a diving board into the swimming pool. You've got to just dive. And unfortunately, that's the courageous step that every entrepreneur needs to take. In my case, it was leaving a 20-year career where I could have just retired and, played golf. But I thought I had a second act and I could do something interesting and exciting. So I dived off the board. And the question every entrepreneur needs to ask themselves is, do I really want to dive, or would I prefer just to stick doing what I'm doing right now?
And I think a lot of times that sometimes it comes out of necessity, right? Like people need to have a second act. I think other times there's something stirring in the soul that says that, like, there's value that I need to bring into the world. Whereas if I don't bring it into the world, no one's going to, and other people aren't going to live as good of a life as they could if I were not to do this. If I were not to take the risk and be courageous and go do this, other people are going to suffer without knowing it, right? But I look at what you're providing, kind of the lifeline that you're offering to people in financial distress, and the investment opportunity, right? Let's not ignore that what you just said there is that you have the ability to have people offer small investments into the work that you're doing, which creates a great opportunity for people to be invested in the real estate industry, right? Take advantage of this impending crisis, and yet still be, not have to leave their day job to do it, right? I think it's great what you're doing. And the fact that you've done that has given all of us courage to realize, I wonder what I could and should be doing for my act too that would benefit the world.
Well, just think of this. There are roughly 22 million people unemployed in the US right now. Many of them have been laid off. Of all the people I know who've been laid off, because I know a lot of them having gone through multiple rounds of layoffs in big corporations, 2 or 3 years down the road, it was the best thing that ever happened to them, because it forced them to pursue their dream that they maybe didn't have just the bravery, or they didn't have the impetus to go and do it when they were 35 or 40 and they were in a very comfortable position. And so being forced to take action sometimes works out, in fact, always works out for the absolute best in the vast majority of cases. In our business, I never thought we would end up running a fund. People who are earning 1% on their savings put money into our fund and get 8%, that really changes their retirement. So if we continue to hit our target return as we have been for 6 or 7 years, doesn't mean we'll do so forever, because there's always some level of risk. But if we continue doing what we have been doing, that means you're retiring with 3 or 4 times the amount of cash you would have been retiring just leaving it in a savings account. So everybody wins.
So good. I want to jump to the last question, Paul, which is the signature question of the show. You're on the Think Bigger Real Estate show because you are a big thinker. You're obviously doing some impressive things in the financing world. I want to ask you, what is it that Paul Birkett does to continue to be a big thinker, to continue to expand your personal possibilities? What does that look like for you?
I think the single biggest thing, and it's a well-worn phrase, is avoid working in your business, but work on your business. When I look at my calendar, all day today, all day tomorrow, I'm working really on 2 things. Solving problems that just filter up to my desk, that no one else feels like they have the stripes to solve. And to every one of those people, I ask them one question: what is your recommendation? I'm not here to solve the problems. I'm here as a coach and to help and provide feedback and training to people. So that's the first thing that I'm doing, is I'm trying to push people to come up with recommendations. And the second thing I'm doing is trying to establish where we go next. So here are the people that I have available to me. Here are their skill set, and the market is out there. How am I going to interface the skill set that I have of the people that I work with all of the opportunities in this wonderful country? And there are more opportunities here than anywhere else in the world. And I've lived in most of the other places that people think of to go and start businesses. So it's 2 of those things: forcing your people to really think at basic first principles and come up with a proposal for every problem. And secondly, how do I match the resources available to me to the market opportunities that are out there?
And I love your perspective that there really is no better place. All right, some people might be listening to this outside of the US, but I think most people are here domestically. And we oftentimes look around at, the problems that our country has, and they're legitimate problems. But compared to the rest of the world, there's no more fertile soil to go create the life of your dreams, create an impact in the marketplace than right here, right? If we can't do it here, you can't do it anywhere. So thank you for that perspective.
There is no way I could have done, Justin, what I've done here in 6 years in Europe or in any of the countries that I've lived in. It would just be impossible. Only in America.
Yeah. Thank you for that. What a great perspective. So thank you so much, Paul. It's been such a pleasure to have you on. What a pleasure to meet you. Where can people go to learn more about automation finance, whether they want to continue to follow you in order to learn more about how to position themselves amidst the upcoming housing changes, industry changes, and or to potentially be an investor in your fund?
Well, on the upcoming changes, so I'm a data nerd, so every month I do a video. It's about 9 or 10 minutes long. It's on LinkedIn, and I break down all the data of anything that's related to domestic real estate or residential real estate and the mortgage market, and those they are best friends. You've got to understand both. And on the fund, there's 2 things you can do. You can go to the SEC website and read our placement memo, or go to automationfinance.com and you'll see it there also. And you can watch the videos there, and you can link with me on LinkedIn, and I'm happy to answer any questions that people have.
Awesome. Great stuff, Paul. Thank you again so much for coming and contributing and for taking that leap, right? Had you stayed in the corporate world, or had you just stayed on the golf course, we wouldn't be having this interaction. You wouldn't be having the impact upon your customers and clients, the people that you're serving, as well as upon us. So I want to thank you for your example of courage and for following through on your act 2. It's exciting. So appreciate it very much.
Pleasure to be here. Thank you.
All right. Thank you, everybody, for tuning in. And let me remind you these 3 simple words, and they are a charge and an invitation from me, which are to go think bigger. Thank you, Paul, so much for helping us do that today.